overview, I'm going to look at Chapter 7. You want to scale, partner with other investors to purchase a multifamily property. What we're looking at here is you have extra capital, you have some single-family homes, and you want to pursue the economies of scale and potentially greater returns of investing in a multifamily property. Realistically, that can be cost prohibitive for individual investors. So a common path is a group of investors pool capital, so basically put their cash together and pursue a single deal together. The potential returns can be outstanding, but prior to doing it, you have to understand how to analyze one of those deals. In the real estate world, we do that through something called a pro forma, which is a financial model that analyzes the purchase and operations of a commercial property, in this case, a multifamily property. Chapter 7 walks through what I call each step of the pro forma and, by extension, analysis process. Every pro forma is going to be different. Some more detailed, some less detailed, some pre-tax, some post-tax, but the underlying logical flow of all of them is the same. That's why I provide this foundational pro forma to teach readers and potential multifamily investors the nuts and bolts of the logical flow of building a pro forma and analyzing this deal. Then you can download it for free off my website, play with it, adjust it to suit your needs. But if you understand the underlying logic of this model, you can really analyze any deal. What we start with is confirming the rents. So look at what is the rent roll of the stabilized property. So there are already tenants in there. There may be some vacancies, but you have accurate information about what the rents are. That flows directly into the operating budget. So we flow the rents through, and then we look at the operating expenses, or OPEX. The residual, or net operating income, is a key metric in commercial real estate because that NOI flows directly into determining the property value. With single-family homes, we can use market comps or comparable properties to project a value of a home. With multifamily and commercial writ large, it's tougher to get those apples to apples. Properties are so different that you can't really do the comp model, so instead the industry uses this thing called a cap, or capitalization rate, and NOI. So the NOI divided by the cap rate gives you the income derived value of a property. So when we project the value of the property based on that NOI, that lets us then back into the permanent financing available. So what size loan can we secure based on a loan to value and debt service coverage ratio test? With that information, we can then back into what's called our sources and uses. So this is the specific ways we are going to allocate money to the deal and how that allocated money is going to be used. So the sources down in the bottom, we just identified the permanent loan. We know how we're going to use the money up top. So the gap is the cash gap that we need to add. And that's typically divided between a sponsor, the person going after the deal, and then the investors, the people who are committing in a limited partner or investor member way. And that tells us how much cash we need. In this hypothetical example, comes out to about $675,000, or about 34% cash financed or equity financed and 66% debt financed. From the sources and uses, we can project our returns. So you're not going to be able to raise capital, nor should you invest in a multifamily deal if you don't know what the projected returns are. Because if it's a return that's lower than, say, comparable certificate of deposit or CD rates, why go through the risk and hassle of investing in property? So this model projects out to 10 years, and we're basing it on assumptions, but what we get is projected returns on the deal. In this example, I project an internal rate of return, or IRR, of 9.6%. What we can move to next, since we've demonstrated that we have two classes of equity here, we have the sponsor equity and then the investor equity, we have what's called an equity waterfall. This isn't necessary depending on how you structure the deal, but if you have different tiers of capital, of equity capital that is, then the waterfall is a tool that shows you how are the deal's proceeds passed throughout the lifetime of the the deal. So in this case, we have a tier 1 where everyone's getting their return of capital and investors are receiving up to 8%. Once that 8% hurdle is hit, then we go into this second tier, the sponsor promote, so the incentive for the person finding the deal. And what we see at the bottom is, due to these promotes, the investors have a slightly lower internal rate of return projected than the whole deal, and the sponsors, with their promoted interests, have a slightly higher. That incentivizes performance and incentivizes them going out, chasing, securing, and operating deals. The book in Chapter 7 dives into all this. I just wanted to provide a brief overview of what the model looks like, but the important takeaway is to invest in multifamily either as a deal sponsor or as a investor looking to contribute capital. You have to understand how the performers work, the underlying logic. So I look forward to hearing everyone's thoughts, and thanks again for the support with the book. Take care.